Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He wrote the top-selling investment book of the 1970s, Crisis Investing. He's also recently been writing fiction books, the Moral High Ground series. His first book was Speculator in the fictional series. I highly recommend going and reading it on Audible audiobook. The second book was Drug Lord. It's about reselling prescription or generic pharmaceutical drugs for a discount here in the United States. And his third book is Assassin. He also is the founder of Casey Research, a paid newsletter company that he sold. And he's a really famous investor and speculator traveling all over the globe looking for investment opportunities. Doug Casey, thank you for joining me again.
Thanks, Jason. I'm speaking to you today from Uruguay in South America.
So, Doug, we're recording this interview on Tuesday, June 4th, 2024. The US dollar gold price is over 2,300. It's rallied a lot since March at $2,326. It's corrected a little bit. I want to get your thoughts on the amount of global currency debasement or monetary inflation that governments and central banks have created. How much do you think that they've created in the last 5 to 7 years?
Well, they publish all these figures, and they have thousands of PhD economists, for what that's worth, crunching them. But look, there are really only three ways a government can get money to do what it wants to do. It can tax its subjects, but throughout the Western world, taxes are in the 40, 50, some places 60% area. Can they go much higher? I don't think so. They can borrow, which just means taxes are put off into the future, and the amount of debt in the world is gigantic. The third way a government can get money is by printing currency. And they're actually forced to do that more and more. The US government is running $2 trillion a year deficits, roughly. And they're financing that by selling the debt that they incur to the Federal Reserve, which monetizes it by crediting the US government's accounts at commercial banks with Federal Reserve notes. So the answer to the question is inflation is going to go a lot higher in the years to come because there's no alternative. Can't tax much more, can't borrow much more, so they're going to print much more. That means higher prices. That's the future we're looking at.
So you're saying that the best case is probably similar to what the 1970 stagflation that you wrote about in Crisis Investing, that you don't see a scenario where the governments allow what a deflation or free market forces, bankruptcies for a long period of time?
Well, they're not going to allow bankruptcies of major institutions like banks or insurance companies. They'll prop them up with loans or bailouts, or actually, if a bank gets into trouble now, there's a process called the bail-in, where the depositors take the hit if you or of an amount over $250,000, which is insured. It used to be $250,000 was a lot of money, but not anymore. Answer to the question is, sure, we could have a catastrophic deflation where there are massive bond defaults, the stock market crashes. But they won't let that happen. That could unlock their whole game. So what we're looking at in the future is just more printing money. They actually think it's a good thing. They think that it stimulates the economy. Well, I guess it does, in the same way as if they printed up enough money and let's suppose this Sunday night, they print up $100,000 for every bank account holder in the United States. On Monday morning, everybody would think, wow, $100,000 extra in my bank account. I'm rich. I'm going to go out and buy a new car. I'm going to go out and use this as a down payment for a bigger house. So it looks like things are better. Everybody is acting as if they're really rich. But this doesn't work. Eventually, you wind up with a kind of situation that we've had here in Argentina forever, or in Zimbabwe in more recent times. Uh, there's no way out. Big trouble. This way comes.
Well, you're also looking at, similar to the 1970s stagflation, now you're seeing it with the consumer price index. It's not coming down where the PhD economists are predicting it would. And so the Fed is stuck, the Fed is trapped because of DC spending. Do you think the new normal now is what, higher inflation rates for consumer prices and shrinkflation and tax increases?
Yes, because the biggest force in the economy is the government itself. It's pretty well captured the economy. It's everywhere in the economy. And as I pointed out before, they can't tax much more. They can't borrow much more. So they're going to print money by selling debt to the Federal Reserve. It actually prints the money. So the general price level is going higher. And I wouldn't be surprised that even by their uh, massaged figures, that we're going to see retail inflation in the 10 or 15% or 20% area in the next few years. It's going to be very bad for the average guy.
Do you think that the DC metro area benefits disproportionately from all of this stagflate, tax lie, money printing, QE, artificially cheap interest rates?
Well, some of the richest counties in the US are those that are around DC. The government takes care of its own first, and federal employees are very, very well compensated for the quote work unquote that they do. So if I was going to speculate in real estate in the US, I suppose at this point, I would say that the area around Washington, D.C. is one of the safest places to be because you've got the world's biggest growth industry centered on Washington, D.C. Yeah, absolutely.
Yeah, I agree. It's the Cantillon effect. And I have government employees, US federal government employees, harassing me on Twitter or X that $191,000 per year that they're grossly underpaid. And I'm not even sure they know what they do at the government with their daily job Monday through Friday.
Well, the nice thing about the government in Buenos Aires across the river from where I am now is that government employees get paid whether they come to work or not, or at least that used to be the case before the last election. So the trouble is that you might think you're doing well by working for the government, but uh, almost everything that the government does is destructive of real wealth and actually destructive of the psychologies of the people that work for it. They're living in a dream world. Things are becoming more and more like the Soviet Union, where they pretend to pay us and we pretend to work. Was the byword.
So when you wrote Crisis Investing in the 1970s, and for listeners out there, it was the top investment book. I mean, Doug did very, very well with that book. That's back when publishers used to give an advance. Was there a strong dollar and higher interest rates and also stagflation and shrinkflation going on now? Was there a lot of similarities to now in the 1970s stagflation?
Things are much worse now than they were in the early 1970s. Uh, but the 70s was a rough decade in a lot of ways that a lot of people are unaware of the fact that uh, by the early 1980s, the US government itself was paying 15% for long-term money and up to 18% on its T-bills. Uh, the so-called high interest rates that we have today are nothing compared to what they were 40 years ago. And I think we're going to go back to those levels of interest rates in the future. Why? Simply because people are not going to buy bonds or any kind of a debt instrument unless they're at least compensated for inflation. So if we see inflation moving up to the 10 or 20% level, which I think we will, you're going to find interest rates moving up to that level and higher. So it's going to be much worse than it was in the 1970s. And that won't be good for stock prices. It won't be good for real estate prices, even though real estate's real wealth. It floats on a sea of debt. And you really can't finance real estate when you're paying 15% or more for a mortgage, which is what's going to happen in the future.
So you expect a long-term secular bond bear market similar to what James Grant of Grant's Interest Rate Observer is predicting, that how there was a bond bull market for about 40 years, and now he thinks that there could be a bond bear market for over a decade?
Yes, I see it exactly the same way because nobody's going to buy bonds. Look, bonds at this point are a terrible investment. They're a triple risk investment. You've got the inflation risk, the money that you borrow, or the money that the bond is worth is going to be depreciating at 10 to 20% per year. Secondly, you've got the credit risk with will you get the money back at all? The US government won't default because it can keep printing up dollars to pay off its bonds. The interest rate risk, the default risk, bonds are not the place to be now.
Well, also the principal value of the bond, right? So if the bond is an older bond and the Fed keeps rates at these levels, aren't there enormous losses for the banks and the bond portfolio managers or the hedge fund like a Ray Dalio or Ken Griffin that leveraged up their bond trades?
Well, that's exactly right. Interest rates were at all-time lows, actually, literally historic lows, back before 2021. And banks were buying those bonds. Now that interest rates are going up, the current value of those bonds are going down. So a lot of banks are actually dead men walking. They carry the value of these bonds on in their portfolios at par, but the market value of these bonds could be minus 30% or minus 40%, so that they're actually bankrupt. It just doesn't show. It just doesn't show on their official balance sheets.
Yeah, to add to your points there, the FDIC just released a report and they're saying that the banks are not marking to market those losses yet. So it's not just older bonds, it's also like losses on commercial real estate mortgages, mortgage-backed securities, other stuff. They conservatively estimate the losses at over 500 billion, but I've seen estimates that it's way over a trillion.
Well, that's right. And in addition to having a lot of bonds in their portfolios, which as interest rates go up, the value of those bonds go down. There are a lot of real estate loans that have been made on commercial real estate. And all across the country, commercial real estate is in big trouble. Buildings are trading at 50% discounts or more. Sometimes it's been as bad as 80% discounts. And I think it's only going to get worse at this point as the economy slows down, corporations contract, leases expire, they aren't renewed. How's the owner of the building going to pay back his debt to the bank? It's going to be a major problem. In fact, what I've been saying for some years is that what we're looking at is not just a depression, it's what I call the Greater Depression. It's going to be much worse, much longer lasting, and much more severe than the unpleasantness of 1929 to 1946.
Well, also the US national debt is growing at a rapid pace. The higher interest rates just make the debt grow faster. They can't tax directly massive increases, even though they're assuming another $1 trillion. But the other major problem, and I think this is a US Treasury supply and demand problem that's developing, it seems that foreigners, Doug, so China and Japan, they're selling treasuries now. They are not net buyers of treasuries, but it seems that the politicians and bureaucrats and central bankers here in DC, they need to sell more debt.
The only certain purchaser of debt is the Federal Reserve. And they purchase it by printing up Federal Reserve notes and depositing them for the US government and commercial banks. So that's quite correct. And incidentally, talking about problems with the dollar. The major export of the US for the last 40 years, since the early 1980s, has been dollars. It hasn't been Boeings or soybeans or IBMs. It's been dollars where this is what the trade deficit is about, which is running about, and it has for many years, been running in the 500 billion to $1 trillion range. And all that money is sent abroad. And in return, Americans get Mercedes and Sonys and cocaine and other things from foreign countries. And what do we pay for? We give them paper. They give us real goods. But what that has resulted in is many, many trillions. I don't think anybody knows what the number is of US dollars that are held by foreigners outside the US. And at some point, when people lose faith in the dollar, those dollars are going to come back to the US, where they must be accepted in exchange for stock certificates and real estate and businesses. And when those trillions of dollars come back to the US, they're going to jam the prices of things sky high. Inflation is going to go through the roof.
You don't
Meanwhile, Americans will be impoverished because it won't be Americans that own America anymore. It'll be the people that use those dollars that were shipped abroad that are going to buy real goods in America. So we're going to see higher inflation, a lower standard of living, and general chaos.
You don't think that those dollars that you just talked about, those trillions, that they're not already going into what luxury condos in Miami or into Nvidia stock or the Mag 7 shares?
Well, some of them definitely are. There's no question about it. But the average American standard of living has been going down for about 40 years, 50 years, quite frankly. And he's a guy that works for a wage, and he's not able to save any money. And the money he does save, he's not being well compensated for it in interest. Eventually, we're going to find ourselves in a position that people in real third world countries find themselves in, where you're living hand to mouth. And even if you do produce more than you consume and try to save the difference, what are you going to save the money in? You save it in the national currency. But how can you save Argentine pesos or Zimbabwe dollars or, frankly, kwaches or dirhams or all of these completely worthless blocked currencies from around that we can find ourselves in the same position as they do. These policies of inflation impoverish people. But you're right. A lot of these dollars have come back to the US to buy luxury condos in Miami and so forth, because people that own these dollars in countries very intelligently want to get their money out of their own countries and into a third country where it's somewhat safer.
So, Doug, you've lived in Argentina off and on for decades now. You set up a similar to Galt's Gulch living community there, similar to what Ayn Rand wrote about in Atlas Shrugged. Do a lot of people in Argentina, do they hedge with Bitcoin, gold, and silver, or in the streets, are they doing what George Gammon showed in his recent videos where they're actually still using dollars and Argentinian pesos for a lot of things?
Just the most economically well-educated people have been using Bitcoin in Argentina, or for that matter, anywhere. The average guy in the street doesn't use it, isn't familiar with it. But Bitcoin is actually quite popular with people that are doing well here in Argentina because it's private and it's international. It seems to be an appreciating asset. You can have, an Argentine can open up a dollar account in Argentina. But in the past, what the Argentine government has done is they've blocked those dollar savings accounts that Argentines have in Argentine banks, forced them to transfer them into pesos, and then the pesos devalued. It's one way of stealing money from people. It's a real problem when currencies are what you use to save with. But if the currency is being inflated arbitrarily, if the currency is being used as a political football, you really can't save in it. So Argentines have saved in dollars because the dollar is vastly better than the peso, but the dollar is on its way to becoming a peso. So what can you do? What can you save in? And the answer to that question is they'll go to Bitcoin and, to a lesser extent, also gold. It's odd. People aren't familiar. The average guy isn't too familiar with gold or silver at this point, but he is familiar with Bitcoin. Bitcoin's become an alternative to precious metals to save with.
Especially if the price keeps rising in the short term every couple of years for speculators, because people aren't buying Bitcoin because they think it's decentralized or they've read the Satoshi white paper. I mean, the majority of people who buy Bitcoin now think that they buy Bitcoin because they think it's going to a couple $100,000 or $1 million in 5 years.
Yeah, well, I think it's probably going to go higher because if you do the math, there are what is the maximum number of Bitcoins? Is it 23 million that can be? What's the number?
I think it's 21 million, give or take and change. But the way the mining is set up is meant to copy what gold mining, where it becomes tougher and tougher. So the miners get less Bitcoin in the future after each halving.
Yeah, it's actually, at this point, it's a very fixed supply. And of the Bitcoins that have been created, and correct me if I'm wrong, if you remember the number better than I do, but out of that 21 million, about 19 million, or on that order, have already been created. The interesting thing is that a lot of Bitcoins have been permanently lost. So there really aren't 19 million in existence. Nobody knows again, but maybe there are as little as 14 or 15 million Bitcoins that are actually available in existence. Some have been lost where people didn't realize they were as valuable as they were. They've lost their passcodes and so forth. So I think it could go a lot higher.
Yeah, as a speculator, I think it's interesting risk and reward depending upon the price. So if Bitcoin were to crash, it would make me more interested in speculating on it again. Back in 2020, when it got down to, I think, 8,000 during the pandemic, I think it was a good risk reward for speculation again. I know Dr. Mark Faber was writing about it back then in his newsletter too.
Yeah.
Last question. So all this currency that's been created, there's 8 billion, give or take, people on the planet. There's a lack of calories for food and all these copper and other metals that are needed for data centers and all these other new technologies. Do you think that there's going to be a commodities bull market, and it's not necessarily going to be on the demand side? You think that it could be on the supply side because there's been a lack of investment despite all the currency that's been created?
Well, that's a good point, because look at the metals markets. To build a gold mine or a copper mine, first you have to find the deposit, which takes millions of dollars and takes years. Then you have to develop the deposit, which takes tens of millions or hundreds of millions. And then, since deposits of metals, whether we're talking about copper, gold, or anything else, all the low-hanging fat pieces of fruit have been picked over all over the world at this point. So you're talking about a giant earth-moving operation next to a chemical plant for all of these things. But who wants to invest billions of dollars for an asset that can't be moved and is liable to be taxed to death and harassed to death by NGOs and local groups and so forth? So that at the very time when the economy, society needs more and more metals, people are less and less willing and able to supply them because it's a crappy, risky business. And actually, the same thing can be said for farmers at this point. Growing wheat, corn, soybeans. It's an industrial, high capital intensive operation. So even though commodities in general are at their lowest level in history relative to stock prices, that's a good argument for them going up cyclically. And I think they will because supplies are going to be constrained. Yeah, I'm a bull on commodities.
Well, we're seeing, to at your points there, we're seeing a lot of problems with policies in Mexico, Peru, Panama, even Chile, which used to be pro copper mining. I mean, their annual copper supply still looks like it's in a permanent downtrend in the last 10 years, despite a rally in copper prices. And in Mexico, it looks like with the elections, potentially open pit mining could either be heavily fined or outright banned.
Well, governments love to use mines as, in effect, milk cows. The whole world has been propagandized into believing that being green is a good thing. And everybody, the man on the street, thinks that miners are raping Mother Earth and it's very non-ecological and you shouldn't build these pits. But they don't realize if they don't have metals, they don't have cars, they don't have buildings, they don't have anything. So that's why the mining stocks are very, very cheap right now, because institutions are afraid to buy them because they're so non-DEI and ESG correct. So at the very time we need more mines and more metals, and for that matter, more food, it's the very time that the society doesn't want them to be created. So as a speculator, I'm buying mining stocks and some agricultural stocks because they're needed, but everybody hates these things. Well, I guess that's what you know, that's what puts in a bottom in the market when people feel that way about any class of securities.
And you've called mining companies what the burning matchstick business, because for a short amount of time, you can do well in them. But if you buy and hold them long term, the match will burn out and you'll get burned.
Yeah, mining is a crappy business for the reasons that I've mentioned. It's easy to tax. Governments are antagonistic to them. The public is antagonistic to them. So they're not a good place for your capital long term, but they are excellent speculative vehicles. The market cap of the whole mining industry, every mine in the world, is a teeny-weeny fraction of the value of Microsoft or Apple at this point. At some point, if the if the price of commodities goes high enough, or if the public psychology changes, these things can do what they've done any number of times in the past. Go upwards 10-1 as a group, with some individual stocks moving up 100-1 or better. They're very volatile, and that's why I like them. It's an area where if you get your timing right, it's possible to hit a long ball home run. I think this is one of those times.
And it looks like big tech, for the first time I've seen in decades, they actually want to be spending on high capex stuff that's involving like copper and new baseload electricity generation in these next generation data centers that use an order of magnitude more electricity compared to the ones that they have now, just for like new technologies like artificial intelligence software.
Well, that's absolutely right. And in order to transmit or the energy, the electricity that's got to be created from building a lot of new power plants, it's going to take a lot of transmission lines, which take huge amounts of copper. But that copper is not going to be available because most of the copper mines in the world are in decline. They've been producing for 10 or 20, 50 years or more, and the deposit is just about mined out. But for the reasons that I mentioned earlier, nobody is really anxious to spend the billions it takes to build a new mine. So there's going to be a squeeze. Probably means the copper is going much, much higher. All the metals are going much, much higher. I hate to even say that about gold, because there have been times when gold has been a giveaway and really, really cheap. Well, at 2,300, 2,400, whatever it is right now, it's not at giveaway levels anymore, but I think it's going a lot higher because we're going to see a panic out of paper and into real things. And gold is actually is money in its most basic form. It's uniquely suited for being used as a money. Paper printed by governments is not.
And central banks are dollar cost averaging, especially outside the G7, they're dollar cost averaging gold tonnage each month. They just bought another 36 tons of net gold in April. So if they're going to do that every month, Doug, that's going to be dollar cost averaging. That's going to put a permanent price floor, I'd say $2,000 an ounce, maybe a little bit higher than that, into the gold price. The gold price in dollars, Doug, it hasn't even kept pace with the consumer price index price increases from all the monetary inflation just in the last 3 to 5 years.
Well, you're quite correct. The all-time high in gold was hit back in 1980 at $850 an ounce. Well, wait a minute. It's $2,300 an ounce now. Yes, but the dollar has lost value more quickly than that. So if gold was even to hit its previous all-time high in real terms, which is to say what it was in 1980 at 850, well, it would have to be something on 3,000, 3,500 in that area. It depends on how much credence you put in the government's official inflation figures. And I trust the numbers coming out of the US government only marginally more than I do those coming out of the Argentine government.
Or the old Soviet Union or the Chinese Communist Party, which also their economic data is heavily spun or outright propaganda.
That's exactly right. So it's a question of every man for himself. And what I'd advise most of your listeners to do is try to produce more than you consume, save the difference, but don't save it in dollars, save it in gold.
Yeah, fiat currencies, I think they're all being intentionally destroyed at this point. I mean, look at the Japanese yen against the dollar, a lot of emerging market currencies against the dollar. The dollar is relatively strong. Interest rates for the US are relatively higher than a lot of other countries. And here we are, there's still a lot of commodities prices rallying since November. So it's kind of similar to the 1970s stagflation, because I think, didn't the dollar and gold both rise at the same time back then?
Well, yeah, there have been times when they both rise together. People all over the world are looking for a safe place to keep their capital where it can't dry up and blow away or be defaulted on, or for that matter, be stolen by their local government. So sometimes these things work together where people are panicking out of other things and into both the dollar and gold. And well, my advice is any strength in the dollar is going to be short term. Strength in gold at this point is going to be long term.
And as we wrap up here, Doug, please tell my listeners a little bit about your fictional book series. I highly, if you're looking for entertainment there, it's written in a similar style to Ayn Rand and Atlas Shrugged. There's a lot of Austrian school economics hidden in Doug's books, in the fiction, in the Speculator series, in the High Ground series, excuse me. Speculator was the first book. It's available on Audible audiobook and also on Amazon.
Well, yeah. What my co-author, John Hunt, and I decided to do was take a hero, in this case, Charles Knight, and follow his progress as he advances into increasingly politically incorrect occupations. And in the first book, Speculator, he makes $1 million, mostly by accident, in a junior mining stock, goes to Africa to find out if there's reality for this company, gets involved in a bush war, makes a lot of money, has a lot of it stolen by the government. Anyway, Speculator goes into a lot of interesting facts about Africa, about mining, and about how to be a speculator. He then becomes a drug lord. We're trying to show that a speculator can be a good guy, but a drug lord can be a good guy too, both with FDA-regulated drugs and DEA-regulated drugs. They steal all of his money again. And at this point, he's rather pissed off and decides that he's going to become an assassin. And we talk about the assassin's trade. And of course, the next book, which I guess we're working on now, is going to be called Terrorist, where having been accused of being an assassin, now he's accused of being a terrorist. And we have a lot of thoughts on terrorism as a method of warfare. So, yeah, they're good reads. And then it gets more radical from there. He goes back to Africa, becomes a warlord, where we show a warlord can be a good guy. So, yeah, I think these books are actually a modern rendition of the ideas of Atlas Shrugged.
And they show like the brutality and the totalitarian control and attitudes of government employees. I mean, like the FDA, the drug lord was just selling what prescription or generic drugs, right? He wasn't, doing drug cartel cocaine and stuff like that. He was just selling discounted prescription drugs or generics.
Yeah, I think if anybody listening wants a really interesting, good read, entertaining, but very educational, all three of those books are actually quite good. And I'm not saying that just because I wrote them.
No, I think they're very entertaining. They're good fiction, but there's also Austrian school economics mixed in there, very similar to the Ayn Rand style of writing. I want to thank you so much for your time today, Doug. Keep up the good work, and hopefully you'll be back in the DC metro area. You can take advantage of the Cantillon effect in the near future and see all the luxury condos and the new restaurants and stuff that are being built here.
Yeah, I hate going to the Death Star, actually. And now's a particularly bad time to be there with the possibility of World War III on the horizon. But nonetheless, appreciate the invitation, Jason.